So in this class we are going to discuss about mutual funds. But before starting that, there are two ways to handle your money. So direct approach, so you can do direct investments or you can do indirect investments. So direct investment means you directly buy equity, that is stocks, or you directly invest in bonds, or you invest in other products. Indirect means you give your money to someone else and then on behalf of you, they invest your money. So whatever returns they get is transferred to you. So it can be mutual funds, it can be portfolios, it can be hedge funds, structures, etc. So we are going to discuss about indirect way of investing called as mutual fund. Okay. Now what are benefits of indirect way vis-a-vis direct way? So benefits are that you don't have to spare time. So time saved time. So you save time because you're not taking care of investment, someone else is doing. You get professionals to handle your money. Then you have better diversification because they accumulate money from different investor and then they invest, so they are able to better diversify your risk. The disadvantage is there is no free lunch, so you have to pay higher charge. So charges that you pay is the disadvantage. So if you think that the time saved, the professional approach and diversification beats the charges, then indirect way is a decent approach to make your investments. Now what is a mutual fund? So mutual fund is an indirect way of investing where investors give their money to fund managers, and fund managers on because investors are giving money to fund managers or mutual fund gives investors units. Now these fund managers, after receiving that money, they invest in different assets. Now if value of asset goes up, the value of unit goes up. If value of asset goes down, the value of unit goes down. So simply in mutual fund, as an investor, you are giving your money to fund manager. Once the fund manager receives that money, he gives you back number of units. Now if value of assets in which he is investing goes up, the value of unit goes up. If value of asset goes down, the value of unit goes down. Okay. Now what is structure of mutual fund? So structure of mutual fund indicates there is a sponsorer. So sponsor, okay, sponsorer, then there is trustee, then there is AMC, asset management company or corporation, then there is fund manager, then there are investors, and then there are assets. So sponsorer is someone who is starting the mutual fund, who gives the guarantee or type of thing. Trustee is someone who handles, means who takes custody of your money, so he is overseeing the AMC. AMC is asset management company. It is actually the mutual fund that is handling your money. Fund manager is appointed by AMC to take care of a particular mutual fund. Investors give money to AMC and fund managers handle that money. Assets are something in which the invest means the fund manager invest their money in. Okay. Now there are different types of mutual funds. The basic type according to structure is close ended, sorry, open ended and close ended. So open ended means anytime you can invest your money, anytime you can go to the mutual fund house, to the AMC, give your money, get units. Anytime you can go back with those units and get your money back. So redemption as well as investments are possible anytime. It doesn't have a closing period. Close-ended mutual funds have three time frames: investment period or the fund call in, then the lock-in period and the redemption period. In the lock-in period, mutual funds will not entertain any new investments or any redemption of units. Okay, but close-ended mutual funds are listed on stock exchanges to provide liquidity. Advantage of open-ended: you can go into the fund anytime, you can go out of the fund anytime. Disadvantage is to maintain that liquidity, most of the mutual funds have certain cash component, thus that cash component produces a cash drag. Close-ended mutual fund, there is no cash drag because 100% of money is invested because of the lock-in period, but there is lesser liquidity because you cannot go take your units and go to the mutual fund and ask for redemption. You can sell those units on exchanges to other parties if they are listed, but you cannot approach a mutual fund. So lesser liquidity for close ended, higher liquidity for open ended, cash drag for open ended, no cash drag for close ended. Then based on where they invest, so asset, you can have equity mutual funds that invest in equity, you can have debt mutual funds that invest in debt, you can have money market mutual funds that invest in treasury bills generally, then you will have gold mutual funds, then you have real estate mutual funds, then you have currency mutual funds, etc. Okay. Then according to style of investment, you have value based mutual fund, you have growth based mutual fund, you have momentum based mutual fund, you have arbitrage based mutual fund, etc. So types of mutual fund based on structure: open ended, close ended, on based on assets, equity, debt, money market, gold, style of investment, value, growth, momentum, arbitrage, etc. Now, how do you analyze a mutual fund? Now, analysis of mutual fund. So first is you look at returns. So you look at long-term returns, 5 or 10 years, and you look at short-term returns. That is 6 months. And you compare it with the particular benchmark or index. So you want a mutual fund to do well in the long run, so it is beating the benchmark in the longer run as well as it is beating the benchmark in the short run. Then you look at risk, that is standard deviation as well as beta. So you want lower risk mutual funds. Then you look at expense ratios or expenses. There are three types of expenses in a mutual fund: front loads, okay, or entry loads. These are also called as entry loads. So whatever charges you pay when you enter into mutual fund management charges, that is the FMC charges that you pay annually, as well as the exit loads. When you exit the mutual fund, the charges that you pay. So you have to factor in all three charges whenever you are analyzing a mutual fund. And finally, you have combination of risk and return. So these are certain ratios. So you have Sharpe ratio, Sharpe ratio. So these ratios combine risk and return. So these ratios combine risk and return. Okay. So Sharpe ratio is simply return on portfolio minus risk-free rate divided by standard deviation. So in the numerator you have return, in the denominator you have risk. And what type of risk is are you considering? You are considering total risk. So what do you want? More returns, lower risk. So you want higher Sharpe ratio. So higher better. Okay. Then you have second ratio, that is trainer ratio. Trainer ratio formula is return on portfolio minus risk free rate divided by beta. So in trainer ratio you are considering returns in numerator over risk free rate, and in denominator you are considering systematic risk, which is part of total risk. And again you want higher returns and lower risk, so higher better. Okay. Third is Jensen's alpha. Jensen's alpha is returns over expected return that the portfolio is generating. So you first calculate expected returns. Expected returns are calculated using CAPM, capital asset pricing model, that gives you risk free rate plus return on market, risk free rate plus return on market minus risk free rate. So RFR, risk free rate plus return on market minus risk free into beta. Okay. Return on market minus risk free is called as risk premium. And you calculate alpha. Then alpha is nothing but return on portfolio minus expected return. So again, more alpha better. Okay. So there are other ratios like Sortino and all. So in Sortino ratio, instead of looking at total standard deviation, we only look at negative standard deviations. Again, higher the Sortino ratio better. So it is similar to Sharpe, except in Sharpe ratio we look at standard deviation, that is total, but in Sortino ratio we only look at negative standard deviations. Okay, Sortino also higher better. So there are two ways to invest, direct or indirect. Mutual fund is an indirect way of investing. Structure, we have seen different types: open-ended, close-ended, based on asset, based on style. Analysis, look for returns, shorter and longer, compared it with benchmark. Risk, consider standard deviation beta, lower is better. Expenses, look at lower expenses in terms of entry loads, FMCs and exit loads. Then look at ratios, combine risk and return. Sharpe, trainer and Jensen's alpha, all three higher better.